Hi everyone, and welcome to Global Finance. If you're new here, I'm your host, a USA-based global finance educator. Before we start, please take a moment to pause and read the short disclaimer on your screen. This video is for educational purposes only. It's not financial advice. Always consult a qualified professional for guidance specific to your situation. Today, we'll discuss what U.S. Fed rate cuts mean historically, how they've affected markets in the past, and what investors like you can learn from them. Simple historical timeline. To better understand the topic, we'll use a simple timeline showcasing key Fed rate changes over time. Core concept. At its core, the video revolves around one key concept. The Federal Reserve controls the federal funds rate, which influences borrowing costs across the U.S. economy. Understanding rate cuts. A rate cut lowers benchmark interest rates, making borrowing cheaper and often boosting spending and investment. However, not all rate cuts are equal. Since 2000, the Fed has adjusted rates over 30 times. Historical examples. Let's look at a significant example. In 2020, the Fed cut our rates by 3 percentage points to support the economy during an unprecedented crisis. The cumulative rate cut of 3 percentage points was the fastest such easing in history. This action, along with other stimulus measures, helped cushion the economic blow. As a result, the U.S. economy recovered quickly from the initial shock, avoiding a deeper recession. In response to these rate cuts, the stock market rallied. For instance, the S&P 500 climbed about 30% from its trough to its peak. Tech stocks led the charge as investors sought companies well-positioned to weather the economic challenges. However, it's essential to note that while rate cuts often stimulate markets, they aren't the sole driver of stock performance. Multiple factors come into play, such as inflation, company earnings, and broader global events. What if you're not invested in U.S. stocks? How do rate cuts impact you? Let's find out. Bonds. When rates fall, bond yields typically decrease. This means that existing bonds become more valuable as their fixed interest payments become more attractive relative to newly issued bonds with lower yields. However, if you already own bonds, especially those with longer maturities, your bond values may not immediately reflect these changes. For example, if you purchased a Treasury bond with a 5% yield before the rate cut, and it has a maturity of 10 years, the value of your bond won't instantly adjust to the new market conditions when the rate cut is announced. This is because you'll continue to receive the 5% interest payment until the bond matures. But once you sell the bond before its maturity date, you will likely receive proceeds that are higher than what you paid due to the lower prevailing interest rates. This is because buyers are willing to pay more for your bond with its fixed 5% yield in a market where new bonds are yielding, say, 4%. Currencies. Lower U.S. rates can make the dollar less attractive to foreign investors seeking better returns elsewhere, potentially weakening the currency. Conversely, if you hold dollars and invest in U.S. Treasuries or other dollar-denominated assets, a weaker dollar could boost your returns when you convert your earnings back home. Let's look at some examples. The USD GBP graph shows the value of the US dollar compared to the British pound over time. When the US Federal Reserve lowered interest rates, the US dollar weakened against the pound, allowing you to get more pounds for each dollar you converted. The USD-EUR graph illustrates a similar relationship between the US dollar and the euro. A rate cut could make the dollar less appealing, leading to a depreciation of its value against the euro. On the other hand, if you're investing in assets denominated in euros, a weaker dollar might enhance your returns on investment. The USD-INR graph depicts the US dollar in relation to the Indian rupee. While there are multiple factors influencing currency exchange rates, a US rate cut could contribute to a depreciation of the rupee against the dollar, impacting your returns on investments made in India. Stocks. Rate cuts can fuel positive sentiment in the stock market, as they often signal economic recovery or growth prospects. Take the example of the S&P 500 index in 2020. The year began with a plunge in the index driven by uncertainty and economic slowdown caused by the global pandemic. However, the Federal Reserve's swift rate cuts aimed at stimulating the economy bolstered market confidence. Investors started to anticipate a quicker recovery, leading to a surge in stock prices. By the end of the year, the index had rebounded significantly from its low point, illustrating the potential impact of rate cuts on investor morale. But remember, while rate cuts can be a catalyst for stock market growth, they don't operate in isolation. Other elements like government policies, business resilience, and consumer behavior also play pivotal roles in shaping market performance. Before moving forward, let's recap the key takeaways so far. Rate cuts can influence various aspects of the global economy and markets. They can affect the stock market, bond yields, and currency exchange rates. However, it's crucial to consider the broader economic context and other factors that can influence these markets. Now let's explore how rate cuts impact different regions of the world, starting with the United Kingdom. UK. If the US Federal Reserve reduces interest rates while the Bank of England maintains higher rates, the yield on long-term US government bonds might decrease relative to the yield on comparable UK government bonds. This difference in yields could attract investors seeking higher returns, leading to an increase in demand for the pound. Consequently, the British pound might strengthen against the US dollar as more investors opt for UK assets. This shift in investment could also impact currency exchange rates. India. A rate cut by the US Fed relative to the RBI's policy rate could put downward pressure on the Indian rupee. This is because Indian investors might find US assets more attractive, leading to capital outflows from India. Consequently, the rupee could depreciate against the dollar as demand weakens. However, if the RBI adjusts its policy rate downward to match the Fed's rate cut, the impact on the rupee could be mitigated. Global markets. A U.S. rate cut can send ripples across global markets, influencing investor sentiment and asset prices worldwide. Let's break down the interconnectedness of global finance. Trade policies. Changes in borrowing costs can affect international trade flows. For instance, if the U.S. Fed reduces rates while other central banks maintain higher rates, it might make it cheaper for businesses to borrow and expand their operations in the U.S. compared to other countries. This could lead to increased exports from the U.S. and shifts in global trade patterns. Geopolitical tensions. Global events beyond central bank policies shape markets. Tensions between nations, political uncertainties, and conflicts can influence investor behavior and asset prices, regardless of changes in interest rates. Central bank actions. Central banks worldwide respond to domestic and global economic conditions. While the U.S. Fed focuses on the American economy, other central banks tailor their policies to their respective countries' needs, sometimes mirroring, sometimes diverging from the Fed's actions. Now let's examine how rate cuts can impact investors differently based on their location. Investors. If you're a U.S. investor considering rate cuts, tracking exchange-traded funds, ETFs, and analyzing sector performance over time can provide valuable insights. For instance, ETFs allow you to diversify your portfolio by investing in a range of securities with a single investment. You can track ETFs like SPY, which mirrors the S&P 500, or QQQ, which tracks the Nasdaq 100. By monitoring these ETFs, you can gauge how major U.S. indices perform in response to rate cuts. Additionally, examining the performance of different sectors like technology, healthcare, and financials can help you identify those that benefit most from lower interest rates. UK investors. For UK investors, diversifying globally can be beneficial. Consider reviewing global indices like the MSCI World Index, which tracks the performance of developed markets worldwide. Past performance is not indicative of future results, but analyzing how global markets have reacted to U.S. rate cuts in the past could provide insights into potential opportunities. Indian investors. Indian investors can explore rupee-hedged options to mitigate currency risks associated with U.S. rate cuts. These options provide a way to protect against adverse currency movements, allowing you to focus primarily on the impact of rate cuts on your investments. As we bring this video to a close, let's recap the key lessons. Rate adjustments are like steering a ship. Small changes have wide-reaching effects. The decision to cut or raise rates is a careful balancing act. It affects borrowing costs, stock performance, and currency values. Every rate cut is unique and part of a larger economic story. What happened in the past might not predict what happens next. Always focus on the bigger picture. Don't rely on rate cuts alone to drive your investment choices. Stay informed, seek guidance when needed, and keep learning. Thank you for joining me today. If you found this information helpful, please remember to hit the like button. Your support means the world to me. Subscribe to the channel to stay updated on our latest videos, and don't hesitate to share your thoughts and questions in the comment section below. I'd love to hear from you. Until next time, happy investing and good luck.